Good afternoon, everyone, and thank you for joining us for today's student loan repayment and refinancing presentation. I'm Migdalia Gomez, the Community Engagement Manager at the Harvard University Employees Credit Union, and I'm joined with Sarah Scruggs, our Community Engagement Specialist. I will be doing the first part of today's presentation, and Sarah will be doing the second part. We both will be answering the chat as well, so if you have any questions, know that we are here to help you. A little bit about how today's presentation is going to go. We have gone ahead and muted folks, so you won't be able to unmute yourself, but do use the questions panel. That will allow us to see any questions that you have. We will go through all questions. If time doesn't allow for it, then we'll just be in contact via email. We also will email you a recording of the presentation and some resources that can help, and a post-event survey that will help us improve so that we can better serve you in the future and make sure to add additional resources that may be of help. A little bit about the credit union for those that may not be familiar with us. We are Harvard's not-for-profit financial institution, same as a bank, but the big difference is that as a not-for-profit, we're able to provide better value, better service, have a better business model, meaning that you as members of the credit unions are owners of the credit union, and we're able to do much more for our community in providing a lot of different support, including presentations such as these as part of our personal finance program. Once you're a member of the credit union, you're a member for life, and unless you close your membership, and once you're a member, anyone in your immediate household, which would include, I should say more than your immediate household, anyone in your family would be also eligible for membership. So that includes parents, your siblings, your children, your partner, and your grandchildren. If anyone wants to learn a little bit more, you can visit our website or just drop a question in the chat and we'll be able to answer. And before we continue, just to make sure that you're able to hear us and know where the questions are, please let us know in the questions panel if you have undergraduate loans, if you have graduate loans, if you're the borrower, or if you're joining today's webinar on behalf of someone else. This will just help us address any questions that you may have. Okay, wonderful. So I see that some folks mostly have undergrad loans. Thank you. This is helpful. And I see that folks are joining for themselves on behalf of, okay, I see some folks are about to borrow a loan and want to know how repayment works. Thank you very much. This is helpful. Sarah and I will make sure to address, we will definitely talk about the different types of loans, undergrad versus grad, but we will also use this. Okay, good. I see someone's helping their daughter pay off loans. Perfect, thank you. This is very helpful. We'll make sure to address the content to all of these. And if you have any other questions throughout today's session, feel free to submit them just as you submitted those questions today. So exactly what are we gonna cover? We're going to go over in the next hour or so, and again, we'll be here, so if you do have questions, feel free to submit them throughout. But we're gonna cover the student loans overview so that we understand. I think most of you understood undergrad versus grad, but then you have private versus federal. So we'll get into all of those. Then we're going to talk about repayment options, really focusing primarily on the federal ones, and we'll go into detail as to why that is. Then we're going to talk about federal forgiveness and refinancing options as well. So we'll do an entire overview, and which is a lot to cover in an hour, but we know we can do it. So we'll just jump right in. The first part is understanding your loans. There are different types of student loans. You have the federal student loans, which are essentially subsidized and unsubsidized. These are the ones that you complete the FAFSA, the free application for federal student aid. And that is, after you complete that form, you become eligible to borrow federal loans. These would be the same regardless of what university or college you attended. There are also federal Perkins loan, which would have been for folks, they stopped awarding those a couple years ago. So if you have had loans, and I want to say it's about 5 years, but I may be off, but if you graduated more recently, you may not have federal Perkins loan. And then there's the PLUS loan, which can be for both a parent. So if I did see that we have a parent on. So if you are a parent, you may have a PLUS loan for your child, or you can also have a PLUS loan for a graduate student. So there are graduate PLUS loans. Any of these are all federal loans. Then you have some state loans. Those really depends on the state. In Massachusetts, we've had the Massachusetts no interest loan. I know that other states also have their own loans. And then you have private loans. These will vary. They can be from credit unions. We have private student loans. You can also have MIFA, the Massachusetts Educational Financing Authority. There's Sallie Mae, Discover. All these different lenders that have student loans are considered private student loans. Even if it's a not-for-profit, anything outside of the federal government is considered a private student loan. And this is going to be an important piece as you start thinking about forgiveness, because we really were going to focus on number one, because those are the ones that will be applicable to everyone that has the same type of federal student loans. State and private loans, the specifics of those are really based off of the terms of that loan that you borrowed. The best place that we will recommend always is going to the main place that we're always going to recommend that you get information will always be straight from the source, which is going to be the Federal Student Aid website, which is now studentaid.gov. They have changed their website somewhat in the past year, even a couple months. So if you're had other websites and you see that you're redirected, it's studentaid.gov, and Sarah has dropped that in the chat. We know that folks are going to have questions about, well, what's happening with federal student loans? Are they going to change? Sarah and I have done our best to keep up with as much as we can with the news. We'll talk about some general information, but keeping in mind that we just don't know. And when I say we, not Sarah and I don't know, but also the federal government doesn't know. So they're still working on a lot of different things. Most recently, we attended a webinar to get a little bit more updates from what's happening with the federal government. It does look like the interest rates are going to go back up. So anyone that has those federal student loans, as of right now, they are at 0%, and they will continue to be so for a couple more months, but that will most likely change. And those are specifically your federal student loans, meaning you were not required to make payment during this time. If you made payments and weren't required to, you could actually contact them to get a refund of those payments. And again, these are just for the federal student loans. So if you weren't quite sure, you're like, oh, I don't believe that's really 0%. I don't believe that I didn't have to make payment, and you opted to make them. And perhaps you are going to go for public service loan forgiveness, or there may be another reason that you decide, you know what, I actually do need those funds. You can do that. For some of you, it may make sense. For some of you, it may not. If you're applying for public service loan forgiveness, which we'll talk about later, that zero payment does count as a payment. So if you gave the government $200, that whether you gave them that $200 or not, those would have still counted, assuming it was $100 per month, that would have counted as two payments. So if you wanted to have more forgiven, you may opt to go and ask for a refund. Again, may not make sense for everyone, and we will provide much more details. I know I'm jumping into a lot at the beginning, but it's an important piece to bring this up to account now. Okay, I do see that that a couple of questions have come in. So I'm going to keep going. I will address those questions a little bit shortly, but do know that we are seeing the questions and we will address them momentarily. So first, I'm going to go into breaking down the federal direct subsidized and unsubsidized loans. So these were previously known as Stafford loans. I did see that we did have a parent on. So if you had attended school and had Stafford loans, they're the same ones. They're the federal subsidized and unsubsidized loans now, just essentially renamed, a couple changes to the program. So I shouldn't say they're the same, but formerly called Stafford loans. These, no credit check was required. Subsidized loan, only available to undergrads. Unsubsidized, the interest accrued while the student was in school. Knowing if you have a subsidized versus unsubsidized makes a difference in your repayment strategy. For any student that is, any person that's in repayment that's anticipating going back to school at least half time, your loans will be deferred, meaning you don't have to make payment. If you have subsidized loans, that interest will not be accruing, but if you have unsubsidized loan, that interest will be accruing. So if you had to choose between paying unsub or sub, typically unsub is the one that's recommended. If you're in deferment and don't have to make payments but wanted to, typically it's recommended that you make payments towards unsub. The rates are going to vary. So if you attended school for 4 years, let's say freshman through senior, and you borrowed unsubsidized loans and subsidized loans every academic year, that would be that you would have 8 different loans. You'd have a subsidized for undergrad year 1 and subsidized for undergrad year 1. Same for second, third, fourth year. That does not mean that the rate that you had for year 1 will be the same rate that you had for year 2. Additionally, the rate that you have for subsidized can also be different than the rate that you had for unsubsidized, even if it was within the same year. I know that that can be a little bit tricky. We are going to provide you some resources where you can get the rates. The takeaway here is that just because they're subsidized, they're federal loans, first of all, that does not mean that they will all have the same rates. Even if they were federal loans that you borrowed the same year, if one was subsidized and the other one was unsub, they could have different rates. Even if they're subsidized that you borrowed all 4 years, you could technically have 4 different rates. Rates used to vary more significantly than they have more recently, but it is common. Like you could have had a 3% subsidized and then a 4% the next year. That is very common. So if you're looking at your loans, you're like, well, why is this one this way? Why is this one the other rate? Rates are set annually for the federal student loans, and they tend to change. Not so much recently, but in the past, they've changed substantially sometimes from one year to another. Then you have the Federal Plus and the Graduate Plus loan. These, I want to point out who borrowed the loan. If it's a plus, just a regular plus, that's under the parent's name. If it's a Graduate Plus, that's going to be the graduate student. If the plus is under the parent's name, the student can technically make payment towards it. Anyone could make payments towards it, but it is the parent's loan. So it's going to appear on the parent's credit report. It could impact the parent's ability to borrow. The student is not involved if it's just the plus parent plus loan. The Graduate Plus loan, that will be on the student's, the graduate's credit report. All of that information will essentially, it is a student's loan. The plus loan, we often get the questions, well, my child now graduated, can I transfer the loan to them? You cannot transfer a plus loan. There are a couple of different things that could be done. You could take the federal plus loan and take it from the federal government and refinance it with a private lender and add the student onto the loan. In that case, it would be under both the parent and the student's name. After some years, some lenders may give you the option to discharge or to remove the parent from the loan, but the parent plus loan, it's not as easy as transferring it. And we do get that question often. Well, you know, my child wants to pay it. They can technically do that, but it will still be the parent's loan. A couple of other things for the plus loan. When repayment begins is going to depend on when you chose that repayment. For the plus loan, for the parent specifically, that there's no deferment unless it was chosen. And if it was chosen, then you have 6 months until 6 months from when the student stopped being enrolled, at least half time. That is when that payment will be due. For Graduate Plus loan, because it's a student loan, it follows the same student rules, which is the 6 months. Interest rate, again, that federal loan, anytime you see a federal loan, know that the interest rate may vary, typically will, and that will be the same case. If a parent borrowed the plus loan all 4 years, they would have 4 different interest rates, same for the Graduate Plus. Private student loans, I'm not going to get into too much with these because they really do vary. I like to compare the private student loans the same as you think of different credit cards. An American Express versus a HBCU credit card versus a Bank of America credit card, a Discover credit card, all 4 will have different terms, they'll have different rewards. Private student loans work in the same manner. They're going to be based off of the lender. Who did you borrow with? What are those specific terms? I would recommend going onto the lender's website, going onto the repayment section and seeing if you have any benefits associated with that loan. Typically, you could have a cosigner release option. This is similar to what I mentioned with the plus loan and what some families sometimes try to do, but essentially it means that if you have a private student loan that's under the name of the student and the parent, or family, relative, friends, doesn't always have to be a parent that's on that student loan. But if the student loan has someone else on it and the student is now making payments, they could possibly have that cosigner released from the loan after they've made sometimes 3 years, sometimes 4 years. It will depend on the lender. But after making on-time payments for a certain number of months, but really it's truly years, then that student could ask to have that loan, that cosigner released from the loan. So if it is a person A and student loan, student makes all the payment, person A can no longer be on the loan, meaning that it would only be the student's loan. So that is a way to get that loan off of, no longer actively on that co-borrower's credit report. And interest rate reduction, this tends to be pretty similar across the board with all of them. You could essentially have your student loans reduce about 0.5 percentage point or 1/4 percentage point. It will depend on the lender, by just setting up automatic repayment. So it's a very simple thing to do. And it may not seem like, oh, is that really going to make a difference? Sarah will go through refinancing and you'll see that it all adds up and it does make a difference. Yeah, I see a couple of questions. I'll take a moment to answer one that's relevant to these slides. Can I talk a little bit about credit score implication? What happens when you pay back a loan in full? Does your score go up or down? Does maintaining the debt help you as it shows responsible payment pattern? Really good questions. Sarah's probably going to drop in the chat a link to Green Path Financial Wellness. They are accredited credit counselors and they can actually look up your credit report. It will not impact your credit score, and they can give you much more customized, individualized information based off your situation. I'll do a general overview of that, but ultimately what can happen will depend on your credit file. If you don't have any other loans or debt, not necessarily that you're carrying in month to month, but if you don't have any other account, like if you only have a student loan on your account and pay it off, after a certain number of months, if not utilizing credit, your score can drop. But if you have a credit card that you use and also have a student loan and you're paying off that credit card monthly, that student loan, paying it off could impact your score slightly. It could go down, but assuming you continue to utilize that credit card, don't have to carry a balance, you don't have to carry debt month to month, but just utilizing credit by paying off that credit card in full every month, your score should either remain where it was or increase depending on your utilization, how long you've had that credit card. It's very specific. So what I would recommend is contacting GreenPath because they can give you more information based off of your individual credit file. Most likely there will probably be a change to your credit score when you pay off any loan. For most individuals, it tends to go up and then down, but sometimes it goes down then up. It really will depend on what else is on your credit report. So I can't give the specifics, but I would recommend contacting GreenPath. We also have on our YouTube channel a link to a credit presentation that we've done where we spend a good hour just going over what impacts your credit score and what those different factors are. Taking a look at that may also help have a better understanding of how your payment history, length of credit can also impact your credit score. But thank you for asking that because that is a very good point. You know, want to make sure that once you pay off that loan, you're still maintaining a good score. But overall, I wouldn't recommend maintaining debt necessarily just for a good credit score. You can do that without having to carry debt, and GreenPath can give specifics to that. The next steps I would recommend with your loans, first, okay, so we know the type of loans that we have, but what are the details of those loans? We recommend writing down the amounts, the rates, the terms. We have a couple of worksheets on our website. We have a page, hbcu.org/hub, where you can download a handout, and if that's helpful, utilize that worksheet to list out your student loans. If you prefer doing it in Excel, go with Excel. If you prefer pen and paper, go with that. The key here is knowing that the loans, just because they have the same names, does not mean they'll have the same rates, does not mean that you owe the same amount. Why is this going to be important? Because knowing the amounts, the rate, and the term will help us determine the cost of the loan. Or another way of saying that is, what is the total interest that you're going to be paying with these loans? That total interest that's being paid is going to help you in determining different repayment strategies Do I refinance? Which loan do I pay off first if I have additional funds? All of that is going to be a good baseline, will be knowing what the cost of the loan is, which essentially is that interest that would be paid. You can also pull your credit report if you have not done that in the past, because there you'll be able to see all of your federal and private student loans and state as well. So any loans that you have that have been reported to a credit bureau will appear on your credit report. It does not impact your credit score to check your credit report. You could do it once a year previously, but due to COVID, that has been changed. Now you could do it once a week. Most of us do not need to pull our credit report that often, but know that you can pull it once a week through April of next year. And there are 3 different bureaus. So I would recommend, if you haven't gone through this process before, pull it from all 3 so you can compare what does Equifax say versus TransUnion versus Experian. There are times that a lender may only report to one. It's not as common, especially if they're one of the big lenders, but there are times. So it could be that one of your student loans may not be on all reports. Not as likely, because student loans, most lenders are reporting to all 3, but still recommend looking at all 3. This will let you know exactly what you currently owe. Well, I should say, it will let you know what you owe as of the time that it was reported, but it's a good benchmark to get started. So once we know what federal student loans we have, another step is knowing our repayment options. And I believe, Sarah, please correct me, I believe Sarah's gonna walk us through this.
Yes, I will be.
Okay, so I'll
Thanks,
turn it over to you.
Perfect. So we're going to talk a little bit more about federal repayment options. During this part of the presentation, we'll be talking more specifically about federal loans, and then we will be getting into refinancing, which is more about private loans. So do know that this is specifically federal repayment options. Federal loans are known to be pretty good in the sense that they have a lot of options to do a lot of different types of plans for paying back those loans that you may have taken many years ago, or maybe just a few years ago, or maybe taking in the future. So the first that we're looking at is those basic repayment plans. This is what every student will be on right when they graduate, is going to be the standard. Your payments are broken up into 10 years of payments, and it is the same payment every single month for 10 years. A lot of folks find that with a basic repayment plan, with their first job or first couple of jobs, they're not able to pay that back. That is maybe too high of a balance for them to pay back month to month. And so they find that maybe an income-driven plan may work better for them. And income-driven plans are specifically plans that are sensitive to your income, hopefully watching it grow over time. So then your repayment options will also grow as your income grows as well. So you see there that they have quite a bit of income-driven plans. You may be on one of these plans. You do have to specifically request to be on one of these plans. It doesn't just automatically refer you to this plan, but you can ask to be on one of these plans. And you can find more information about these plans online as well. If you go to that studentaid.gov website that we've put in the chat a couple times, they have a plethora of information on each of these plans. But do know that the basic repayment plans, those are going to be a standard. You pay the same amount each month, except for that graduated is what you'll see. But the standard may be a little bit too high to pay back, and that's okay. You can go into an income-driven plan. On the next slide, we talk a little bit more about deferment and forbearance. So let's say that you are not in a place at this point in time to be able to pay back your student loans. First thing you need to do is contact your servicer. So let's say that you have, you know that your federal servicer is Nelnet, possibly. And so you contact them and say, you know, I've been unable to make payments. They'll give you a couple of different options, and we just want to make you aware of what those options possibly could be for you. One would be a federal deferment. Most people are in federal deferment when they're in school for at least half time. So if you borrow undergraduate loans and then go to graduate school, while you're in graduate school, your loans are technically in federal deferment. because you are going to graduate school. So you do not have to pay on these loans. There is no like late penalty or anything of that nature. Of course, your interest is accruing during that time. So that's something to note. But during this time, you're pausing payments. And this is under specific conditions. So they can only do a federal deferment under specific conditions. They can't just go giving a federal deferment to everyone. They have specific rules for this, but it is a really good option if you're not in a place to be able to pay them back. Like you are not a full-time worker, you only work, part-time because you go to school at least half-time. That's an important reason to talk with them and say, you know what, I'm not going to be able to pay on my student loans right now because I'm a part-time student or full-time student. Those are really important things to point out when you do have those conversations with your loan servicer. And then there's forbearance. Forbearance is different because this is for folks who don't qualify for deferment. And this allows you to temporarily postpone your repayment. Going into forbearance is okay. This word may sound scary, or you may be like, you know what, that doesn't sound good. It's okay to be in forbearance. It's much better to be in forbearance than just to not pay your student loans back at all. So what you need to do to be in forbearance is you would talk and have a conversation with your federal loan servicer and say, I don't think that I qualify for any types of deferment. So are there any other options that you all have? This allows you to hopefully get to a place where you're able to make those payments. So let's say you are on an income-based repayment plan, but your income really hasn't gone up like you wished it to. Talk with the servicer and see if there's anything that you can do. Are there any other payment plans that might be better for you at this time? Are there any other things you can do before going into forbearance? Or maybe you do need to get into forbearance, and that's okay too. This would be if you don't qualify for any type of deferment, but it does allow you to temporarily postpone your payments. So like I said, both of those options that we just looked at are much better than just not making payments at all, because there are consequences to missing payments. It can affect your ability, it can affect your ability to borrow in the future. Why is this? Especially with federal loans. So if you end up getting a mortgage through the federal government, it could affect your ability to borrow that because it will show up on your credit report that you've missed payments on a federal loan. So you want to make sure that you're continuing to make your payments, the minimum amount of payment that you can, as you work with your servicer to come up with a solution, just making sure that you're making those payments. It could increase the amount you need to repay because your interest is still accruing on the balance that you have. That's something to remember. With your federal loans, your interest is always going to be accruing on those unsubsidized loans or any plus loans that you have with the federal government. So it is important to remember that this is increasing the amount you need to repay, not only because of the interest, but possibly because of fees, late fees, could be because you need to pay additional fees for being late. That sometimes can happen as well, can negatively impact your credit score because it does show up on your credit report. Like I said, it does show up on your credit report, and you want to make sure that people see when you do go to borrow a loan in the future that you've done everything you can to make sure that you're not missing payments, but that you are in some sort of deferment or forbearance. That will be looked at much differently than if you've just not made payments for 5, 6, 7 months. That's why it is so important to contact your servicer and see if there's any way that you all can work together to figure something out so that you can stay on time with your payments. And then if it gets to a point, the government will eventually intervene and they possibly can take your wages, they possibly can take your tax refund, Social Security benefits, or any other income that may be coming towards you. So do know that that's why we emphasize speaking with your servicer if you are at a point where you can't make those payments, that it is so important that you speak to them and get on a plan so that you're able to continue your financial journey successfully rather than just not making payments. So now we're getting to a point where we're thinking about what are some other options. Maybe, I'm making my payments, I'm doing things on time. What are some other options that I may have? So let's go to the next slide and see what some other options may be. Forgiveness and just discharge options. Um, this is a really great word. Forgiveness is a really great word for student loans, as well as discharge. So there's a lot of different reasons to possibly receive forgiveness or discharge from your federal student loans. Know that this is just for federal student loans. And you see there too that they do have a Perkins loan cancellation and forgiveness. But this could be for teacher loan forgiveness. There are opportunities for teachers to get their loans forgiven, possibly. If your school closes, there are opportunities to get your federal loans forgiven or discharged because of that. And then, of course, there are other opportunities for you to get forgiveness or discharge. But we really want you to get out of this particular slide is the resource there at studentaid.gov/manage loans/forgiveness and cancellation. This is a really great place to go if you do have questions, if you qualify for possibly any of these discharge options or forgiveness options. The one that most people will ask us about, and the one that we probably get the most questions about, is public service loan forgiveness, or PSLF. You've probably heard of PSLF or public service loan forgiveness quite a bit. I think in the past couple of years, I've definitely heard about it more in the news and things of that nature. But this is a loan forgiveness program for those folks who go on to work in public service after they graduate from college. Public service looks like a lot of different things. If you work at a 501c3, you could possibly qualify for public loan service forgiveness. If you work in a public school, you could possibly qualify for this, including a public university. If you work for a nonprofit hospital, you could qualify for this. And what's so important is that you need to remember that this is for anyone who works at those entities. So you don't have to be doing something in particular towards public service to get your loans forgiven. If you are working at a school, say you are a cafeteria worker at a school, you would still qualify for PSLF because you work and get your paycheck from a nonprofit that qualifies under public service loan forgiveness. There's a question in the chat, is PSLF only for federal loans? Yes, public service loan forgiveness is only for federal loans at this time. And so what does this program look like? What do you have to do to qualify for public service loan forgiveness? First, this forgives a remaining balance on your direct loans from the federal government after you've made 120 qualifying monthly payments. 120 qualifying monthly payments is 10 years. So you have to have made 120 qualifying monthly payments towards your student loans in those 10 years and have been working at an eligible employer for those 10 years. You don't have to work at the same employer for 10 years, but if you work at multiple places, they all have to be eligible for that public service loan forgiveness. And forgiveness is only granted under a qualifying repayment plan. You have to be under a specific plan to be able to get the public service loan forgiveness. If you speak with a servicer about this or fill out the ECF, which is that is where you certify that you're working at a employer that does public service loan forgiveness. It's a form that you fill out online. If you go to that website that you see on the page, this is a great place to get information about it, but you can fill out that form and you have to make your qualifying payments under a specific plan. And your servicer will know what plans will work. So make sure to fill out that form for yourself. And like I said, you must be working for a qualifying employer, but on top of that, you must be working full time. Whatever full time is defined as by that employer. So some employers, full time is only 40 hours. and some employers full-time is 35 hours. It just depends on the employer, but you must be working full-time based on that employer and what they say is full-time. And like I said, you can look up a list of what qualifying employers are. There are definitely a lot of nuances. If you're working in the military, that is a public service, and so the public service loan forgiveness would cover you. But like I said, there is some paperwork that needs to go along with this. Filling out that paperwork is so extremely important. I highly recommend, if you're even possibly thinking about public service loan forgiveness, go ahead and fill out the paperwork to explore if that even would qualify you to be able to be a part of the program. And they've made the public service loan forgiveness hopefully a little easier to understand in these past few years, but I highly recommend learning more about this program if that's something that you believe that you will qualify for. And like I said, going straight to the source is one of the most important things you can do with student loans. And with any federal loans that you have, studentaid.gov is your place to go. But specifically with the public service loan forgiveness, you can look up tools to help you figure out if you have been under a qualifying employer, helps you assess whether your loans qualify for PSLF. So there are some really great tools on this website that you can use if you're thinking that PSLF may be good for you or maybe your dependent that you're helping pay back loans with. So now we're getting into refinancing. And this is something where refinancing really covers a lot of different bases. You are absolutely allowed to refinance your federal loans. And you are allowed to refinance your private loans. Refinancing may be a good option for you, maybe now, but maybe in the future. And that's what we want to say and make you all aware of. And something that we don't recommend right now is if you have federal loans, we don't recommend refinancing those at this point in time. And for some, it may make sense. Very few, I would say it makes sense to refinance federal loans at this time. But because we're at 0% interest and no private company is going to be at 0% interest for student loans, but the federal government is until the end of September. So what you need to remember is that maybe right now isn't the best time to refinance, but the principles of refinancing will still make sense possibly in October. So consider refinancing if that possibly is a good option for you. But if you do refinance, there are a few things to remember. So on the next slide, we'll talk a little bit more about what refinancing is, and then we'll talk a little bit more about what to consider before refinancing. So just to be all on the same page, really understanding what is refinancing. Refinancing is a new loan that you receive from a bank that combines private and/or federal loans into one new loan for you. So let's say you have 2 private student loans, you have 1 federal student loan, and you really just want to put them all into one loan that has the same interest rate, the same repayment period. You only have to pay back 1 bill. Then that would be refinancing. So what are some of those benefits of refinancing? Why would somebody want to refinance? Well, for folks who have private student loans out there right now, it may lower your monthly payment. You may be able to lower the amount of money that you're paying back on those loans because they may lower your interest rate. 1 monthly bill, 1 interest rate. If you have 4 or 5 different student loans, you probably have a lot to keep up with. It is a lot to remember. Okay, now who am I paying for how much, and how many more payments do I have? This just helps you get on one level with all of your loans. And typically there's no application fee and there's no prepayment penalties. Massachusetts is very good at protecting their consumers, specifically with loans, and so there are no prepayment penalties in Massachusetts. But if you are somewhere else, there could possibly be prepayment penalties, so make sure that you are asking this question before you refinance. Prepayment penalties would be if you decide to pay on your loan early and pay it off early, would they be charging you for holding that loan for the rest of the time? That is important to ask. You do not want to pay them money because you're able to pay it off sooner than you first thought you would be able to. And one thing to note is that federal consolidation is different from private refinancing. Federal consolidation is taking all of your federal loans and putting them into one, which you would do through a servicer, a federal loan servicer, whereas refinancing is taking all loans from private all the way to federal. You can also just refinance private loans if you want to. You're taking all of those and putting them into one and getting a whole new interest rate, whereas with consolidation, they would find an average interest rate for you. So what are some things to think about before you consider refinancing? So you want to make sure that you have a great credit score. That's one of the first things to think about. There are some private companies that do base your interest rate off of your credit score. So if your credit score isn't where you want it to be at this very moment in time, it may not be the best time to go ahead and refinance. You may want to wait until you get a credit score a little bit where you want it to be. And Migdalia already spoke about our friends over at GreenPath, but they can talk with you about bringing up your credit and ways to do that specifically. You may lose benefits that are associated with the original loan. This is why we aren't encouraging folks to refinance their federal loans at this time, because there are a ton of benefits that come with federal loans, just like this one, the 0% interest rate until September. That benefit is on no other loan anywhere else. That is only with federal loans. When you refinance, you are moving your loan from one bank or one company to another. So you can't go back and use those companies' benefits. We like to say it's like you moved out of an apartment, but you really liked that apartment's dishwasher. You can't go back and use that apartment's dishwasher even though you live somewhere else because you're no longer a customer of theirs, so you can't take advantage of any of those benefits. And this is really important to remember, especially if you are refinancing with federal loans. Definitely something to remember. And your repayment term almost always begins right away. So if you had a grace period with your previous loan, a lot of times you will no longer have a grace period. With private loans, sometimes there just is no grace period with them. And so that is something to remember as well. If that's something you are counting on, having that 6-month grace period after graduating to be able to start those payments, that may not be there any longer. Like we've said, GreenPath Financial Wellness offers free credit, budget, and COVID-19 counseling. So if you do want to speak with somebody in a one-on-one conversation that can look up your information and they're accredited credit counselors, they're a great resource. Highly recommend that you take some time to learn a little bit more about GreenPath and give them a call if you do have questions about credit. So what are some repayment strategies when you're thinking about student loans? We like to tell people there are definitely a couple of different ones that you can hopefully use all together to better your repayment strategies. So you see here that our current loan is $40,000 and our interest rate is 8.5%. That is a pretty large, hefty monthly payment. We have the loan term for 8.6 years or 103 more payments. And the total interest paid over the life of the loan will be $16,314. We calculate this out because it is important to see how much you're paying to essentially just borrow this money from this company. And it is so important that you understand how much money you will just be paying on top of your $40,000. So one strategy that we just spoke about is possibly refinancing. So you're going to get a new rate in a new term. So you still have that same amount of loan, your $40,000 loan, but now your interest rate has dropped 3%. Great, that's a really good time to go ahead and refinance. The 3% drop would be enough money for you to go ahead and refinance. Your monthly payment drops a little bit, and your loan terms are now lengthened. So you've now signed up to make these $434 payments for 10 years instead of those 8.6 years. So you are elongating the amount of time you'll be paying this. That's something to keep in mind. But the total interest paid will drop by about $4,000, which you definitely like to see. That is one of the great benefits of refinancing. So that is the reason that you've gone ahead and got this new rate. So now we've decided, you know what, I'm going to go ahead and refinance, but I was able to pay that $552 pretty regularly and within my budget. So I think I'm going to stick with paying the old rate or the old amount of monthly payment on the new rate. So this means that my loan term would actually shorten. I would actually be able to pay this off in 89 months instead of the original 103. And I would save about an additional $4,000 from just refinancing. So again, we are dropping that total interest paid pretty low. And that's something you want to look out for when you are trying to figure out what strategies you want to use. So this is a great strategy, using that new interest rate that you've gotten through refinancing, but saying, you know what, I can pay that original amount. And one last one is doing a new rate. So we've got our new rate, we've locked in that 5.5%. But now we've decided, you know what, in my budget, I'm able to pay $575 a month. That's going to save you additional funds and additional time. You're going to be paying that off in 7 years instead of 7.4, so you save 5 months, almost half a year. That's pretty good. I know what I could do with $575 for 6 months instead of pay it towards my student loan. So this is important that you do calculate these things out so that when you are strategizing, how can I pay this back in a way that will save me time and possibly save me money in the long run? And you can use our calculators for this. At the credit union, we have a page that's dedicated to all of our calculators, and you can actually play around with your own numbers. So once you use your credit report, you can actually see exactly, you know, maybe if I get a new rate at this percent, how long will it take me to pay off? If I start paying these monthly payments, how long will it take me to pay off then? How much money will I save? I definitely recommend going to our calculators page, which is huecu.org/calculators. And that's a really great resource to use when you're comparing repayment strategies to see which one would be best for you and your family. Definitely recommend taking some time to look through your options and see which strategy may work best for you. Like Migdalia said, we do have multiple resources on our website, including handouts. So this is a handout all about student loan repayment. I highly recommend, if you're a visual person, go ahead and look on our website at the hub and print this out for yourself so that you can compare those strategies. You can calculate out these whole costs, and you can see exactly what your next steps are. Migdalia and myself would love if you filled out our survey for us. Migdalia will be dropping the link in the chat for you to fill that out. It is a short survey, we promise, but if you could just complete this for us, it really helps us in knowing better how to serve you and how we can continue to make these presentations a success. So if you could just take one moment to complete that survey, we'd love that. So what are the next steps you need to take today? I highly recommend writing down what is one thing that you want to work on in these next couple of weeks as we move into the summertime. First thing you need to do is do your homework. Figure out exactly what student loans you have and what are your repayment terms at this point in time. Do your research. are you eligible for loan forgiveness options that maybe you haven't been eligible for before? Or is there something new that's popped up that you'd be eligible for? And then calculate refinancing. See if it's a good time for you to go ahead and refinance your private student loans. We highly recommend calculating these things because we want to know those exact numbers and what's best for us when we do decide to go ahead and refinance. And obviously, all this information is just educational in our examples, but we want you to go ahead and figure out all of the other things with a professional if you do have questions. All of our contact information is here. If you have questions for us, we do want to take we have about 9 minutes left in our time with each other today. If you do have additional questions or anything we can clarify, we do ask that you put those in the questions feature or the chat feature, either located on the right-hand side of your screen or up at the top navigation. So if you could let us know if there are any questions or things we can clarify for you all, but we'd be happy to answer anything that's left.